Hey guys, welcome to AI Trading Live with your host, myself, Robert Grzesik, where what we do is we build trading algorithms live and test them out, see how they do, and make some money using AI with trading. Let me share my screen with you guys and we can get this kicked off. We have actually added a lot of really cool new features that I think you guys are going to love. And we'll be able to show you essentially all the new things that we got. And we can actually make some really cool trading strategies today. All right. So again, welcome to AI Trading Live with your host, myself, Robert Grzesik. And we're going to be using the website BotSpot today to build out some pretty cool AI trading strategies. I think you guys are going to love what is possible with BotSpot. Okay, so first of all, a little bit about me. So I've been programming for over 25 years, going on 30 probably. So I've been doing this for quite a long time, big majority of my life. I was just a kid when I learned how to code. I have a master's of finance degree, so I do have an education in this stuff. I sold multiple tech companies after I finished my master's degree. It worked out pretty well. I worked on Wall Street for a number of years. I helped create a company called Voyager, which you may have heard of. We actually used to basically pay for NBA teams, which is pretty damn cool. So if you're actually, what was the NBA team that we sponsored? But we used to sponsor NBA teams. We actually grew to be quite a large company. So I was employee number 5 at Voyager. We're basically a Coinbase competitor. Where you could trade crypto on our platform. We grew quite quickly. We grew to be over $1 billion in valuation on the stock market until the FTX collapse brought down Three Arrows Capital, and they owed us about $600 million as a loan, which took our company out. It's kind of hard to survive as a startup if someone owes you $600 million and doesn't pay you back. But it was a pretty cool run while it lasted. Went from basically 4 people in a WeWork all the way into being worth $1 billion and sponsoring NBA teams, all that kind of stuff. And now I'm the CEO of Lumiwealth BotSpot, where we're working on using AI to make it easier for you guys to make money. Hey, here's our agenda for today. This is what we're going to be focused on today. First of all, we're going to talk about how BotSpot works so you guys kind of get an idea of what's possible, what this thing can do. We're going to take a look then at existing bot performance. We're going to see how our bots are doing, how are my bots doing, how are some of the community bots doing as well. Then we will plan out a new bot or changes to existing bots. Then we will build or modify bots using AI, and then we will see the results. We'll see how things actually go. All right. So quick disclaimer. I am not a financial advisor. This is not financial advice. If you want financial advice, go call a financial advisor. This is me trading my own portfolio with my own money. So you can watch me do trades for myself. Anything that I say within the confines of this conversation and outside of this conversation even is not to be taken as financial advice. It is simply what I think I want to do with my own money. And you can watch me trade my own money. Okay, so here's how BotSpot works. So you guys understand what the platform is like. So basically, there are 2 paths you could take through BotSpot. You can either take the first path is go into the marketplace, see existing strategies, see strategies that other people have built, and you can basically copy, modify, run them. You can actually take a strategy that was trading Tesla and change it to use Palantir using AI, for example, or you can just take the bots that are there and just run them as is. And then path 2 is building your own bots. You could use our AI bot builder or our AI agent to basically build a strategy for you, research and analyze different strategies, back test strategies. It'll give you code suggestions, and it'll help you actually deploy and run these strategies. And then we connect to a bunch of different brokers. As you can see here, we have Alpaca, Schwab, Tradier, Project X, Tradeovate. We connect to a bunch of different brokers. So if your broker's on that list, you could directly connect. If it's not on that list, I'd recommend actually checking out some of the brokers on this list. Alpaca, for example, is a fantastic broker. They're based out of San Francisco, growing very, very fast. They're kind of like Robinhood for AI trading. So they're a fantastic broker to work with. We also have a deal with Tradier that we'll be announcing sometime soon, where if you create an account with Tradier, you can actually get our services for free for a few months. So that's something that we're working out as well. Right. So basically, you can either use an existing strategy or create your own and then link it up to a broker and trade that way. All right. We do not take custody of your money. That sits at your own broker. You have a relationship with them. You simply link it to the platform. Okay, so I'm going to give you a quick walkthrough of the website, the basic features. Basically, you could view public bots, you get access to marketplace, and you can open the AI bot builder. So let me walk you through exactly how that works right now. So first thing you're going to do is you're going to go to botspot.trade, BOTSPOT.trade. All right, and when you get to this website, it's going to look something like this. This is our homepage. We're actually updating our homepage probably tonight. So look a little bit different when you guys see it, if you look at it in the future. And basically, you hit this website, and then you have some big buttons here that say create an AI strategy or view marketplace, and their buttons are also at the top. Let's say if you clicked on view marketplace, you can actually see some of the strategies that have been created by our community and how they're doing. So for example, here's a Palantir bull spread strategy. In the past 24 hours, it's up 9%. That's pretty amazing. We can actually click into it. So this thing is up 9% over the past 24 hours, right? You can see here, or one person actually is gotten almost 11% return. That's pretty damn cool. Or past 7 days, up 4% or 2.5%. And then you can see all time. You can also see back tests. Here's the back testing results. This is simulated trading going back. This one's going back to 2024. This one's going back to 2023. So this is how this bot would have performed in the past based on our back testing results, which is quite nice. You can see some pretty nice returns here. Since 2023, you can see a 57% return, right? That's one of the bots. The rest of them here, you can see we have other ones running. We have our alpha picks running. This one actually just got started up. Historically, we actually need to put in our historical results for this one, but this one's done very, very well historically. Same with our diversified leverage bot, has done very, very well historically. Annual return of about 19%, or our TQQQ bot, which has had an annual return of about 36% when we back tested it. So some of these bots have quite nice performances, especially when you look at the backtesting results and you look at them long term. The market's been a bit off the past few weeks, which is actually the kind of strategies I want to build out today. So I've been thinking a lot about building a bot that makes money when the stock market goes down, because we're seeing this whole thing. We're seeing the stock market maybe not responding the best right now to a lot of new information. We seem to have stopped this whole bull market over the past few weeks. So I'm actually very interested in making some bots that make money if the market goes down, right? So that's going to be something that we can actually talk about today. But here's our marketplace. You could go browse around. You can see basically the back testing results, what the results were here, right? Our best back test is this weekly momentum option strategy, had a back test of 700% a year. Pretty crazy. Palantir had a back testing result of 400% a year. Our Condor Martingale had 120% per year annual return from the back test. So these back testing results are quite good over the past week. Maybe not the best performers, but again, the market just has been really choppy. And I've been thinking a lot about making some bots that work well, even in these kind of scenarios that we're in right now. So that's our marketplace. You guys can check that out. Go into each one of these strategies. And then we have our AI bot builder. If you click on create AI strategy, you might be prompted to actually log in, put in your email and phone number. And when you get here, it's basically going to ask you, what do you want to build today? And you can actually go ahead and say, I want to build a bot that does X, Y, Z, right? Let's say I'll say something like, I want to build a trading bot that makes money when the stock market crashes. Right? Let's say I say something like that. I'll put that into this AI. We'll wait for it to respond. This thing's been hyper tuned to be very good at these types of things, right? You can see here it's reviewing public bot performance. It's actually taking a look at what are the bots that have been working out really well. Okay, we got a response back. It says to build a bot that profits from market crashes, we typically use short or inverse strategies. Here are the most effective approaches we can automate. Let me zoom in a bit so you guys can see this. Inverse ETFs is one thing that we can do, right? The bot buys ETFs such as SQQQ, right? We could do that. We could do long put options. The bot buys put options on the S&P. So if the market drops, we make money. And we could also do short selling. So bot borrows stock like Apple or SPY and sells them, hoping to buy them back for cheaper, right? And then it says, what would you like? Which way would you like to take? I'm not going to keep going with this. I mean, if you want to keep going with this, you could say, you know what? I want to do put options. I want to do this. I want to do that. And it could keep going. It'll build out the strategy for you. However, what I want to do is I want to keep going based on a strategy that we built actually about 2 weeks ago in one of these sessions. That's the one that I am actually very interested in. So we had a put bot that we were working on. I think it was this one, our TQQQ trend with QQQ leap puts. So I'm going to search that strategy up. This is what it looks like here. We have the strategy. It explains basically under the details. Oh, look at that. Something strange going on with this one. Okay, we could actually take this bot description. I'm gonna get another version of this AI to build this out. But basically, this is what we created. We created a strategy that aims to ride the long-term uptrend of the NASDAQ 100 via TQQQ while carrying a steady layer portfolio insurance with QQQ put options. So it's buying TQQQ, which is a leveraged ETF, and then it is basically buying put options in case the market drops. So let me say build this strategy. This is a strategy that I want to use. Say build this strategy. There we go. Okay, and basically I'm getting it to build this, right? So here is the strategy aims to ride the long-term uptrend of the NASDAQ 100 via TQQQ, which is something that is a triple leverage NASDAQ. If you take a look at how well TQQQ has done, you'll see why it's one of my favorites to trade. Look at TQQQ. Look at how well this thing's done over the years. If you go max, this is in Google Finance. Since 2010, when it came out in February 2010, it is up 23,000%. That is pretty damn crazy. So whatever money you put in times 233, right? So let's say if I put in 10,000 bucks, that'd be $10,000 times 233. We would end up with a very, very nice result there. So 233 times $10,000. Let's say if I put in 10 grand into this ETF, I would have $2.3 million right now. Pretty damn crazy. All right. So turning 10K into $2.3 million since 2010. That is pretty damn impressive. It's why I really like this ETF. Again, basically, it's the NASDAQ. It's the QQQ times 3. So if the QQQ is up 1%, this thing's up 3. If the QQQ is down 1%, this thing's down 3. Right? So it's one of my favorites to actually trade. However, it is one of those that crashes pretty damn often. So you can see here, it reached a peak of $42 in 2021. And then we had the bear market of 2022 and it dropped all the way down to like $8, $9, right? So this thing moves a lot. That's like a 75% drop. That's pretty damn crazy. It's not something that I would want to put all of my money into, but if we would trade this thing, we actually have one of our strategies trades this thing being a 200-day moving average. You actually can get rid of all these big drops and you end up having a much more smooth transition upwards, which is kind of what this strategy does. But we actually took this one and we added a little kicker to it where if it's below the 200-day moving average, it's actually going to buy put options as well, right? So we're saying here a TQQQ price must be above the 200-day moving average to hold the position, right? And then the hedge uses QQQ puts with expirations around 6 to 12 months and strikes from at the money to about 15% out of the money, right? Okay, and let's see, we could see the rest of the description here. right? If in trend, the strategy targets up to a 90% account in TQQQ. If not in trend, it targets 0% in TQQQ. Okay, and then the hedge targets about 7% of the account using QQQ put options with expiration 6 to 12 months out and strikes from the near current price to about 15% below it. Option trades are skipped when pricing looks poor. For example, spreads are too wide, right? Risk management. So basically, it's buying TQQQ only if we're above the 200-day moving average. And then we're also owning these put options in the meantime so that if something falls, we actually even make money off of it, right? So pretty damn cool. So this is a strategy we started working on about 2 weeks ago. You can actually see a flow diagram of it here, if that helps, right? Is TQQQ trend data available? Yes. Is the TQQQ above the 200-day moving average? If yes, then target 90% allocation to TQQQ. If no, then it's 0%, right? Either way, adjust the TQQ position if we need to, then check and adjust QQQ put hedge, right? So it's basically doing this no matter what. We're always owning these put options, and then update counters and logs. Okay. And if I wanted to, I could actually even ask. So you can see here that it automatically started a back test for me. Let's see how that back test is going. Right. There you go. It failed for some reason. We're going to use the AI to fix why it failed. There's some sort of failure. There's a big button there. We can click on fix using AI. So we're going to see what is going on with that one. But we could also ask this AI, we could say, how is this thing trading? Does it trade? Like we could ask little questions about this, right? Does this thing always own put options, right? That's something that we could ask, right? Does this thing do this? Does it, there's a lot of things that we can review about it, right? We see here it tried back testing. You can see here that there's some sort of issue with back testing. Spot a syntax error. For some reason, it's importing future annotations. I've actually seen this before. I don't know why this keeps happening, right? But there we go. It's inspecting the code, and we're going to get that fixed, right? In the meantime, let me show you the rest of the stuff here. You have your tabs at the top. You have your chat. You have your history. These are all the different things that I've done in the past. We have strategies that have been created. They can actually search through and use. Then we have on the right-hand side here, the details of the strategy, how it actually works. We walk through that. You can see deployments if you actually want to run this thing, and running it doesn't necessarily mean real money. You can actually run it with fake money, and that's kind of what we recommend to a lot of people is when you build out a strategy, back test it, see how it would have done historically, but then run it with fake money so you can see actually the performance of it as well in that regard. Okay. Then we have the code. If you guys are coders, this I could see here, this is the problem that actually happened. I don't know why our AI keeps doing this. We'll make sure that that does not happen, right? Let me do a quick note to myself here because I've been seeing our AI do some funny business with this. Bug. Okay. So this is basically a thing that's getting fixed right now. And you can actually see here if you're into code, if you are a coder, you could tell here that this is Python code. You could actually do whatever the heck you want to do with this thing, right? So here's hedge candidate. It's talking about the strategy. These are the parameters that were set, and you can actually modify these by hand if you want to do that, right? Then here's how it actually functions. This is what it does when it initializes. Here's a safe float. For some reason, we have that. Is the trade big enough? Right? Compute SMA, get trade signal, all these different things in here. If you are a coder, you could actually grab this code. And you could run this basically wherever you want, right? Yeah, there's a copy button down here, and you could actually use this code and run it in any way that that you see fit, right? Then we have our back tests. We're going to see hopefully a new back test start running in a second here. It says starting a back test. Let's see if it could actually fix it. And we can get this back test actually running. There we go. See it's starting a back test automatically. And let's see how this thing performed, right? There we go. It looks like a short back test from November 17th until today. We can see basically how this thing would have done. It's been running for about 31 seconds now. We'll see what the results are of this back test, right? What do you guys think? Do you guys like this kind of strategy where we're buying put options? What do you guys think? Where do you guys think the market's going to be heading over the next little bit? I've been personally myself reading quite a few books lately. One written by Ray Dalio, which this book right here, very good book, Ray Dalio book. This is a book I read recently that actually there's two that he came out with. This is How Countries Go Broke. This is actually his newest edition. They're both about kind of the same thing. If you haven't read this book yet, I highly recommend it. It's a very good read. So basically talks about kind of the predicament that the US is in right now, how the US is actually in a lot of debt, which has a lot of implications, right? We could either go down a path of inflation and inflate our way out of the debt, or we can go into austerity and stop spending, which is kind of a lot of what Trump has been doing by like firing people in the government and all that. It's reducing spend. There's a bunch of different paths that the country can go down, right? And some of them are going to affect things differently, right? Does that mean that you're going to want to buy gold, or does that mean you're going to want to buy stocks, or what kinds of stocks you're going to want to buy? It's a very interesting read. If you haven't read it yet, I highly recommend you give it a read. Or actually, what's really cool too is you can actually even talk to ChatGPT about this book. I got, I think, a PDF of the book, and I gave it to ChatGPT, and it actually was able to answer some pretty cool questions. It's influenced me to want to basically buy a lot more commodities, right? So I've been thinking a lot about buying gold companies and things like that. I've been thinking a lot about buying companies with shorter duration, right? Meaning, there's a lot of these like high flying tech companies, the AI companies that make money far, far in the future. Those tend to be riskier things around periods like this. So I've been thinking about more buying things like, the Walmarts and the McDonald's, those types of companies. And also a lot of international stocks. I've been kind of looking around, what are some international buys that we can make? This book has been a very big influence in my life. I wonder if you guys would get a very good result from it as well. I'm also reading another book right now called 1929, right? By, what is his name again? Book, Andrew Ross Sorkin. This is another really good book that I just started reading. It's a very good one as well. If you have not read this one yet, I'd highly recommend reading 1929 as well. It might freak you out a little bit, but it's actually a really, really good read because you start to realize how similar 1929 is to our current predicament, right? There's actually a lot of parallels. It's actually kind of scary because in 1929, what happened in the 1920s was a lot of retail investors got into the stock market and they started investing on margin, right? Which means basically borrowing money to invest in the stock market. We got a lot of really high valuations in certain stocks. We had a lot of leverage in the market, so a lot of debt. So if you think about it, there's a lot of parallels to today. The Robin Hoods of the world really got a lot of retail traders in. A lot of people have been investing on margin or with other types of leverage, which definitely puts a lot of risk into the system. We are actually at a very high valuation right now for the stock market. If you take a look at S&P 500 PE ratio, for those of you that don't know what a PE ratio is, it's the price to earnings ratio. It's basically how expensive is the stock market. And if you look at it, we are at historically high levels right now. We're at about a 30. This is as of, when is this exact number? The 30 is, I'm trying to get the exact date. Yeah, December of 2025. We're at a 30 PE ratio on the stock market. If you just draw a line across here, you could see we're at one of the highest valuations in history. This goes back till 1871. And you can see here we're at a 30. The average has been about 16. The median has been about 15. We're pretty damn close to the peak right now. So if you're thinking about, is the stock market expensive? That is a huge indicator, We're at a very expensive stock market right now. You could make the argument that it's expensive because AI is going to have such a profound impact on the world, and therefore we're going to have higher earnings growth rates, right? That earnings are going to be growing faster because of AI. Sure, if that's your take, then maybe this PE ratio is justified. However, I'm a bit more conservative than that. I'm a big believer in AI. You know, we run an AI company. We build some really cool stuff with AI, and I think it's going to be incredible for the world. However, when I see valuations like this, it makes me think maybe this is not the time that I want to be leveraged in the market. Maybe this is not the time that I want to be super pushing for these high valuation stocks. And it makes me want to be a little bit more conservative, right? So if you guys haven't read these books, Ray Dalio, How Countries Go Broke, and Andrew Ross Sorkin, 1929. These are two very good books, I think very relevant to what is happening right now as well. And again, if you do a little bit of research, it doesn't take much, look at our PE ratio on the S&P 500. Another really big red flag that I'm seeing as well is the fact that we're seeing very high government debt, right? So if we type in government debt to GDP ratio, right? And let's see if I can get just for USA graph long term, right? You can see here that the debt has gotten really out of control. This is since 1970, 1966. It'd be great if we could actually go back further in this. But I mean, our government debt is about as high as it's ever been in all of history, at 118, right? So that means 118% of GDP is our debt, right? So this is typically how we measure indebtedness of a country. We do a ratio between the GDP and the actual amount of debt, because it's not just about how much debt you have. It's about what relative to what. Look at this. In 1980, we were at 30%. Today, we're at 118%, 120%. It's coming down, which is nice, but that's probably also why we're seeing the market come down as well, because this is eventually going to have to stop. We're eventually going to have to bring down the debt. We're eventually going to have to do something about this, because eventually you just can't pay it, right? There's math involved here, right? Like if you're indebted this much by a country, you're gonna have to pay this back at some point. You have to pay interest, and it does put a drag on the economy. If this keeps going up, it gets more and more expensive to maintain, and eventually you either are forced to reduce it, or there's a crack in the system, and maybe the US dollar goes bye-bye. That's kind of happened throughout history. If you read this book, How Countries Go Broke, this has actually happened many times in history. It happened to the UK, it happened to the Netherlands, it happened to a bunch of other countries, that it happened to Rome back in the day. It happened to a bunch of other world powers. So hopefully we're not heading in that direction, but it's not looking so hot. And it's making me think, hey, maybe we want to be investing in some stuff that is not going to explode if things go sideways, right? Which is why we're working on the strategy here, and we actually got a result. Cool. Let's see what result we got here. Okay, so we got our strategy here. This actually looks pretty damn good. It's buying TQQQ and it's buying put options. We got an annual return of about 30%, pretty damn good. Only a 66% drawdown. Very, very good here. I'm thinking this is real nice. This is a short back test, only about a month. Back test this back a year is what I'm going to say to the AI. So it's going to go back, and we're going to get a back test going back even further, and let's see if we get similar results. And this actually seems pretty good to me. This is a strategy that's buying put options, so it's going to protect us if the stock market falls, right? Presumably. But let's see what happens in the back test. This actually looks very interesting to me so far, right? This is the kind of strategy that I'm thinking. I want to have a strategy that basically, if the stock market falls apart, we're still making money, right? That's kind of what I want. That's what I've been thinking about lately. Okay. And we're going to watch this back test go. While that goes, I'm going to try to adjust my charging here because my laptop is actually dying. So I need to plug it in here. So let me get that. While we run this back test, we'll see what the results come back as. Right, can you guys hear me? I'm going to plug this in. Get a microphone back. Okay, let me know if you guys can hear me. I had to make a little adjustment here with the microphone. There we go. And yeah, cool. So I got the microphone back. I got my laptop charging. Hopefully this is going well. Yes, I'm not seeing it fall immediately. Okay, and we're running a back test now over a year time period. Let's see how this turns out. But I'd love to hear from you guys. There's a chat here that you guys can actually type into, right? Let me see here. I see ADZZ. You're saying invite Discord if you want to save on food. I found Discord server. Get you discounts on DoorDash. Okay, thank you for letting us know that. Let me know what you guys think about strategies that you would actually want to be running right now. What do you guys think would make the most sense in terms of a strategy to make money in the current time period that we have in the market? Right? I'm thinking I want to buy, like I said, I'm looking to buy strategies that make money on the way down. So that's why I like this put option strategy here. We can actually just directly make money. If the stock market falls, we basically own insurance. We just directly make money off it. That's actually something that I find very interesting. I'd even be thinking about having like a bot that only does that, kind of like a Michael Burry style. I've been thinking about making a bot that basically just like shorts Palantir and shorts some of these like really high flying names. They're companies I actually love. I think Palantir is a great company, but the valuation, oh my goodness. Um, Take a look at this. Here's something interesting. We're going to open up another bot spot session, and I'm going to show you guys how you can actually ask this AI. We'll say, what are the most highly valued companies right now based on price to sales, right? That are large cap on the S&P 500 or NASDAQ, right? So what are the most expensive companies right now? And I'm looking at price to sales. And the reason why I'm doing that is because a lot of times you can value a company based on price to earnings. But the problem with price to earnings valuation is that some companies, they don't have big earnings, right? So for example, if you were to value an Amazon using price to earnings ratio over a longer time period, you would not have gotten a very good result because it would have looked always very, very expensive to you. But if you're looking at it on a price to sales ratio, it looks different. And the reason why is because Amazon, for the longest time, would simply reinvest their money. They on purpose kept their earnings low or even negative in some cases because they just want to keep reinvesting into the company. So it made their earnings look very small, even though their sales were jumping like crazy, right? So that's why I kind of like the valuation of price to sales rather than just looking at price to earnings. I think it gives you a little bit more of a clear picture. And I actually did this analysis on Palantir versus Google versus Apple versus some of these other ones, and we put together a little table. We'll see if we could get that to show up here. And there were a couple companies that are like, you know what, they're great companies, but do I really want to own something like, for example, Palantir? I think it was 100 times sales. Like that was just absolutely ridiculous, right? Let's take a look at this here. So Palantir, right at the top of the list, right? This is Michael Burry. He was actually talking about shorting this company, and I kind of agree with him, right? Look at this, 115 times sales. You know, for a company to be worth that much, we're talking about they need to be 10xing their revenue like every year for the next couple of years, or else this is just insane. Like if you're not doing 10x your revenue every single year, this is completely absurd. And maybe they'll be able to do that. It's not impossible. It's possible that could happen, right? But what's the probability that's going to happen, right? And then also, if we're talking about the scenario that might happen from Ray Dalio's "How Countries Go Broke," what he talks about is because we're in a different situation right now, we might actually see when the Federal Reserve lowers interest rates this time around, we might see interest rates actually go up rather than down, right? Because what happens typically is when the government cuts interest rates, they will lower short-term interest rates, right? They'll lower the overnight lending rate to banks, right? Which then influences the 1-year rate and the 10-year and the 30-year rate, right? And usually they all come down, right? However, when you're in an inflationary environment like we are right now with the government debt where it is and all that kind of stuff, also, where we lost a big debt buyer through China. China's no longer buying a lot of U.S. debt, and they would usually buy the long-term debt, the 30-year and things like that, or the 10-year. When we're in a scenario like that, if a shock happens and the Federal Reserve lowers interest rates, it's very possible that long-term interest rates go up rather than down, which would be very unusual, but has happened in history many times before when countries were in similar situations to us, right? Where because the Federal Reserve lowers interest rates, which lowers rates across the whole board. However, long-term rates go up because of inflation expectations. So if inflation goes up, then long-term rates go up. And if long-term rates go up, companies like this get hammered. These things get hit very hard because all of their money is not coming in today. It's coming in a year, in 5 years, in 10 years. You're expecting this thing to grow, right? Which is okay, even if the company doesn't get affected and it's still going to grow very quickly, then you're still going to have a problem because these cash flows are being discounted at a higher rate going out further. So Palantir, to me, that's right on the chopping block, right? AppLovin, this is also pretty high, 34 times sales. I know they've been growing fast. They've been doing really well. Cloudflare, CrowdStrike, Broadcom, NVIDIA. Look at this. These are all names that have been doing very, very well lately. However, if something were to turn against it, these could be the ones that fall the fastest and the hardest. So what I'm thinking is I'd actually love to have a strategy that's simply shorting these, right? Buying put options on these. Hopefully I'm wrong, right? Hopefully this doesn't happen. Hopefully we don't go through that scenario. But if I'm right, these things could pay off big time. You own a put option on a Palantir, and if this thing falls 80%, you can make a heck of a lot of money trading the put options. So that's kind of what I've been thinking about lately. Is making a strategy that basically owns put options on this. It's kind of a hard one to backtest because you'd have to see things that have happened in the past. I think, if we went over like the tech bubble or 2008 or, the bear market of 2022 or something like that, we could actually see if we own these put options, how would this have done? I think that'd be a very interesting strategy. Speaking of which, let's see how ours is doing. So far, so good. It's been running for almost 10 minutes. We have a back test running here and actually has made some money. Went from 94,000. Okay. We can actually watch this thing. This is actually kind of fun to watch. We can actually watch while this thing trades. So it's down a bit right now. This is from March 31st. So we're actually running a back test. I think we don't have the full time period here, But this thing is back testing, I think, where is it? There it is. From December 18th, 2024 to December 18th, 2025. So we're back testing it to basically today, pretty much exactly 1 year. Okay, and we're seeing that so far it would have been down a bit for the year. Okay, this is in March. This is actually when we had the big drop in the stock market. So this is probably because we owned TQQQ. We saw a big drop, but then we could see if our put options protect us here. It's actually not too bad, given I think the entire stock market around this time period was down almost 20%. So given the fact that we're in a leveraged instrument, we're trading TQQQ, this is actually not too bad. So we're going to keep watching this. We'll see how this thing does. We'll watch this back test actually run. Okay, now we're in April 1st. Yeah. Now we're in May. Right, we could actually watch this thing trade. Okay, and it's actually going up here. So we see by August 7th, it actually trended up a bit. All right, I'd love to see, I'm going to open up on another tab here. I'd love to see actually how the S&P was doing around this time period. Look at that. In October, it's actually shooting up again. Boom. So we had this drop. This is at the beginning of the year. This is a $100,000 account, so it dropped to 81,000. So it had about a 20% drop, which is not too bad given the amount of leverage this thing is trading with. Right, and you can see here, we're ending up about, we're somewhere flat. That's actually not, it's not that crazy. We'll analyze this thing right after it finishes. Right, once this thing finishes, we could actually talk to the AI and we could say, hey, this thing ran and it didn't go up that much. How is this doing versus S&P? Let's actually take a look here. If I was trading the S&P 500 over the same time period, 1 year, it's up 15%. This bot would have been up so far looking like about 2%. Actually ended a bit down. So total return, it ended down about 5%. Okay, so this strategy, maybe not the greatest right now. Let's get AI to analyze this. Okay, why did this happen? So I'm going to ask this AI. I'm going to say, can you analyze the most recent back test and tell me why it lost money? I would have expected it to have gone up a bit. And let's actually check. How's the NASDAQ doing? 'Cause that's what it's actually trading against. Let's go QQQ. How did the NASDAQ do over the past year? Yeah, because NASDAQ is up 17%. Because the QQQ was up 17% over the same time period. And we own the TQQQ, so I would have expected to make some money. However, maybe the put options were too much of a drag. I'm thinking, maybe we should use less of the account in put options, or maybe we should, buy further out of the money or something like that. Right? We could also, would a put spread have been better? Right? We could ask a few questions around that. Okay, so let's see what this analysis comes back as. So I would have expected this to actually do pretty well. This thing owned TQQQ. So we can actually take a look at what happened here. We have a lot of analysis that we could do. So here is the TQQQ. Here's all the trades that happen. Well, you can see this thing is trading quite a bit. It was buying and selling TQQQ quite often, which doesn't seem right to me. Right? Why was it buying and selling TQQQ so often? Hey, we can get the AI to analyze that. Here it's buying, put options. Here it bought the put option, right? And it bought it right around the bottom. Here it bought the put option. And then here it's just trading TQQQ back and forth. Right? Maybe it's just trading TQQQ too often. This doesn't seem right. We'll have this AI analyze this thing. Okay, and then I could also take a look at some of the other stuff here. We could see basically our trades and our tear sheet. Right, here's our tear sheet. This is what it looked like. The S&P dropped. We dropped along with it. It came back up again. We didn't come up as fast. And then more recently, things dropped and we got hit hard near the end. Look at that. This would have lost a lot of money over the past week or two. Which makes sense, but it makes me wonder why our put options are not helping us out. Why are we not getting that boost from our put options? Because I would have expected that to happen here. Okay, here's what the AI said. Based on the backtesting results and the strategy logic, here's the analysis of why the strategy lost money despite the market rally. Total return -5, max drawdown -23, Sharpe ratio -4. Why it lost money, the insurance trap. The primary culprit is a 7% fixed allocation of puts. Here's exactly what happened. Constant drag. You allocated 7% of the entire account to insurance puts in a rising market. Those puts constantly lost value due to time decay and the rising price. Forced selling of winners because the strategy is programmed to maintain that 7% target. Every time the puts lost value, the bot sold. Interesting. So that's why it's actually been buying a lot of these TQQ. The bot sold profitable TQQQ shares to buy more puts. That makes sense. Maybe we got to loosen this requirement a little bit. Result, you are effectively siphoning off all of your TQQQ gains to subsidize a losing hedge. 7% is a very aggressive allocation for pure long puts. Usually 1 to 2% is standard for tail risk protection. That makes sense. Okay, so some solutions, it's saying. Switch to put spread, vertical spread. How it worked, buy 15% out of the money put, but sell a further put, right? This kind of makes it cheaper. That makes sense. Or we could also just lower the allocation, right? Would recommend to do both. Switch to a put spread, buy 15%. Okay. Okay, let's do both of these options. Okay, and let's see if we can get this thing to actually work a little better. So we're going to make it so instead of just buying puts, we're buying a put spread. So that's going to make this cheaper for us to maintain. And then we're also going to reduce it from 7% to about 2 or 3%, which I think would make a lot of sense in both scenarios. Okay, so we're doing this change to our strategy, and let's see how this turns out. Okay, and coming back to this one that we're talking about, companies that have really high price to sale ratios. Like Palantir is just ridiculously expensive right now on a price to sale basis. Part of me wants to just make a strategy that simply kind of copies Michael Burry. He's shorting Palantir. He bought put options, quite a bit of them on Palantir, right? I'm wondering, maybe that's just not a bad idea, right? Just Palantir. MicroStrategy is another one. MicroStrategy is a weird one though, because they don't really make money. So I don't know if I'd add that to the list here, because they basically just own Bitcoin. So they don't really have revenue. So I don't know if I would put this on the list of the ones I would want to trade. AppLovin, though, is definitely one of the ones that could be up here. AppLovin, I know it's been doing really, really well. I don't know if you guys have seen AppLovin, this thing has been a frickin' rocket ship. Look at this. AppLovin over the past year up 122%, or past 5 years up 1,000%. This thing has just been a rocket ship, right? I think what do these guys do? They're mobile technology company. They do mobile advertising, marketing, app discovery, some stuff like that. So I think they do basically marketing and advertising in apps, and they've just been doing really, really, really well. But their PE ratio is pretty damn high. It's around an 84, and we're seeing that their price to sales is like 34 to 45. It's quite high, right? So the question is, maybe we want to be shorting this. Maybe this is something that might be a good idea for us to own some put options on. So if something goes bad, if the market explodes, this thing could make us a crap load of money very quickly. Cloudflare is another one that's quite high up there, right? It's really all the AI stuff, right? It's the Cloudflare, the CrowdStrike, Broadcom is also around AI, Nvidia, obviously an AI company. So most of these are just AI companies that just have these really, really crazy valuations, and they're good companies, but are they going to have gains like this? Because this is pretty damn nutso, right? Okay. So, question is, do we want to make a strategy that just shorts these guys? What do you guys think? Would you make a strategy to short this? How would you guys go about doing this? Let's see. Make a strategy that buys put options, or if you were to make a strategy that buys put options on the top names here, how would you structure it? What percentage of the account would you use to buy the puts, so that the entire account does not blow up if they go up, but can make a lot of money in the event that they have a huge loss all of a sudden? So the expectation is that Palantir will still go up over the next few months, but will eventually get hit hard and drop like 80%. How can we position ourselves to make money in that scenario? Right? That's basically what I'm thinking here, right? Maybe 80% is a bit aggressive, maybe 60%, but like assuming, what if this was the scenario? What if Palantir is going to keep growing? Like, this is what I'm thinking, right? Is that Palantir is going to keep growing. This is a high flying name in AI. I don't expect this thing to drop anytime soon, right? We did have a bit of a correction, but it's not like it was that severe. What I'm thinking is that Palantir is still probably going to keep going up for a little while, but and the rest of these names too, they're probably going to keep going up for some time, but then we're eventually going to hit some sort of snag, right? And this happens in the economy roughly every 2 to 5 years, right? So the last time we hit something like this was in 2022 when we had this really high inflation. Before that was 2020. We had COVID, right? Things like this, they just always happen, right? Like this is one of the most predictable things in the world, is that we're eventually going to have some sort of downturn in the markets that will happen at some point in time. I don't know what's going to cause it, right? Is it going to come from us I don't know, maybe some new virus comes out, probably not. Maybe a war breaks out. I think that's a pretty likely outcome. Taiwan, Japan, and China have been fighting over Taiwan. That could easily trip a world war. You know, there's been a lot of war activity happening lately, which, you know, if the U.S. and China get dragged into a war, that's World War III, basically. What if that happened, right? What if, you know, there's all these things that could happen in the economy, right? Like, what if a big bank blows up? What if, you know, all these like possibilities? It's hard to predict what it's going to be, but I can almost guarantee you that something will happen in the next 2 to 5 years. Almost guaranteed, right? I would bet a significant portion of my money on that. And in that event, I would argue that these companies that are listed here with these extremely high price to sales ratios, these are going to be the ones on the chopping block. They're the ones that are going to get hit the hardest. So, what if this was a scenario, right? What if we had a strategy that basically didn't lose too much money if Palantir goes up? If Palantir and MicroStrategy and App11, if they keep going up, we're not getting killed, right? We want to have something like that like it doesn't lose a lot of money when things are going up. But if these things drop, and I think if they drop, they're going to drop like rocks. I think Palantir in a bad scenario could go down 50% quite easily in like 2 or 3 weeks span. I think it happened really fast and really hard, right? I want to be positioned where in that sort of scenario, this thing just makes a crap load of money, right? It's just like this big lottery ticket that pays off. That's kind of the thing that I'm looking for personally. So how do we structure that, right? This is what the AI is saying here, right? So it's saying to structure a strategy that captures a massive crash without bleeding out your capital during the melt up phase, I recommend a signal-based barbell strategy. Interesting. This approach keeps the vast majority of your money safe or in the market and only deploys a small sniper allocation of puts when the trend actually breaks. Okay, so recommend structure, the allocation, the sleep well rule. To ensure the account never blows up, you should strictly limit the total risk exposure to the option premium paid. Recommendation, allocate 2 to 5% of your total account value to the put options. The math, if you allocate 5% to puts and they expire worthless, the stock keeps going up, your maximum loss is 5%. You retain 95% of the capital. The upside in a 60% crash, deep out of the money puts can increase in value by 1,000 to 2,000%, 10 to 20x. Wow. A 5% position turning into a 10x gain adds 50% to your total portfolio value. Amazing. The timing, don't fight the trend since you expect Palantir to keep rising for a few months. Buying a put now is dangerous. You will lose money to theta, time decay, every day the crash doesn't happen. The fix, use a trend filter. The bot will only buy puts when the stock shows weakness. Interesting. Buy puts only when price closes below the 50-day moving average. As long as Palantir is above the 50-day line, the uptrend is intact. We sit in cash or hold the stock. The moment it cracks that line, the crash probability increases and we fire that 5% bet. Instrument leverage, strike price, buy puts that are 10 to 15% out of the money. These are cheaper, meaning you can buy more contracts for your 5% allocation. Expiration, buy puts with 3 to 6 months until expiration. This gives the crash time to play out without expiring too quickly. This sounds like a really interesting idea. Okay, this sounds interesting. But what if I have the timing wrong? What if it takes 2 years before it crashes? And what are we doing with our money in the meantime? Also, if it's below the 50-day moving average, wouldn't that make put options more expensive to buy in that scenario? Right, so just asking a few questions here. We're thinking about, how do we actually structure this? Okay, this is our strategy that we're basically buying put options on these high-flying companies here, Palantir, MicroStrategy, AppLovin. We also have another bot here that was created. This thing is still refining the strategy. It's taking quite a while to do this. We're going to let it keep running. This is another one we're buying put options on the NASDAQ instead of the S&P 500. So we're waiting for this thing to actually finish refining the strategy. Okay, let's see here. We got, okay, you're asking the right questions. These are two biggest risks with big short strategies, right? This is basically the big short. This is very similar to Michael Burry's strategy, right? This is kind of what he was betting on. Just this thing that makes like a big amount of money in the case of big loss, right? This is basically what the movie The Big Short was about. It's kind of the same way that he placed his bets, right? Okay, here's how we solve both problems to make the strategy robust. What are we doing with our money in the meantime? If the crash takes 2 years, sitting in cash is painful. We missed out on gains. The solutions, we don't hold cash. We hold a core position. How it works, the bot keeps 95 to 100% of your account invested in safe, yield-bearing assets like SGov. That's not actually a pretty good idea. Or broad market SPY or QQQ while it waits. The switch only when the crash signal fires. Palantir breaks the 50-day SMA. Does the bot sell a small slice of that core position to buy the puts? The result, a crash takes 2 years. You've made 8 to 10% on interest or market gains while waiting rather than earning zero. That's a good idea. Won't puts be more expensive after the drop? Yes, you're absolutely correct. When the stop drops, implied volatility spikes, making options more expensive. The trade-off, this is the cost of insurance. Scenario A, guessing the top, you buy cheap puts. Now, while Palantir is going up, the crash doesn't happen for 6 months. Your puts expire worthless. You buy again, they expire worthless. You might lose 15 to 20% of your account just waiting for the crash. Scenario B, waiting for the break. You wait for a 50-day break. You pay a higher premium for puts because volatility is up. However, you avoid all those months of 100% losses. Interesting. The verdict, it is mathematically better to pay a 20% volatility premium once than lose 100% of your option bet 5 times in a row trying to guess the exact top. Interesting. This is very cool. This AI is really giving some very good advice here. These are like complicated option strategies, and this is really, really good advice. Okay, so it's saying the core state, the waiting room, invest 100% of your portfolio into SGov or to earn safe yield or SPY to ride the market. Okay, the trigger. Okay, let's make this strategy, but buy SPY rather than SGov. I'd rather be sitting in the S&P 500 personally. SGov is going to pay me about 4% a year. The S&P 500 historically has done about 10% a year. So I think I'd rather sit in SPY rather than SGov. I think I'd rather do that personally, right? It's definitely more risky, but at least we have that upside. At least we're not getting killed when the market's going up. But in this case, if it turns against us, we're going to make some money. Okay. Okay, let's make the strategy, but buy SPY rather than SGov. Okay, perfect. We're building out that strategy. Let's see what happens. This other strategy is still being worked on. This is taking much longer than expected. Okay. Something happened here. Let me refresh. Let's ask it to do this again. That's kind of weird. Something hit a snag there. All right, we're working on this other strategy, is TQQQ trend with QQQ puts. So these are both kind of same sort of strategies, right? We're buying long term. We're owning some sort of asset that goes up normally. S&P 500, QQQ, TQQQ, something like that. It's making money on the way up, and then we own put options so that if things blow up, we make money on the way down. So these are both very similar strategies in that regard, right? Where we're planning to actually make money on the way down. Okay. All right. We're generating both of these and we'll see how they turn out. All right, guys. Well, it's been a little over an hour. We typically want to keep these sessions around an hour. So I'm going to let these things run. We'll let the back test run. We'll see what these results look like. I actually want to run these strategies, and maybe next week, if we meet next week, because next week is Christmas. By the way, Merry Christmas, everybody. Merry Christmas. Happy holidays. I hope you guys have a fantastic holiday season. Right. And what I'm going to do is I'm going to run these strategies. We'll back test them and I'll share the results with you guys. And you can actually see what happened. Maybe we'll have a session next week, a little bit earlier in the week on Tuesday or something like that. And we can actually see how all this stuff panned out. How do all these back tests work? Are these strategies something that we want to be into, especially as we come into a new year? I think historically, when the new year happens, right after January 1st, we usually have a big drop in the market. And I think the reason why is because of tax loss harvesting, right? So if you've been making a lot of money, and I think this year, I have a feeling the new year is going to see a pretty big drop because a lot of these AI companies have made so much money, and you want to take a profit. But the thing is that you want to make sure you take a profit that's better for a tax perspective. So you want to sell in the new year, right? So if I were someone that made, and I actually have clients like this. We have clients like this where they made a ton of money trading Palantir, trading all these other high flying names. If I were someone thinking I want to take some risk off the table or I want to take a profit, I'm going to wait until the new year, right? I'm not going to sell right now because if I sell right now, I get taxed in 2025. But if I sell literally in 2 weeks, right, when it's the new year, then I get taxed in 2026. So I don't have to pay that tax bill for another year, right? So if I were to take profits off of these AI companies, off these AI names, I would be selling January 2nd, January 3rd. So I would expect there to be a pretty big drop in the markets, especially because of how much money all these AI stocks have made. I would expect there to be a pretty big drop in the new year. So that's kind of what I'm thinking here. I want to position myself in a way to um, either protect myself or even profit in that scenario. So that's what I'm thinking about here. Okay, either way, I'm going to let these things run, guys. I'll get back to you. I'll show you the results once we're done. We'll see the back testing results. We'll see how these things actually performed. And I might actually run these things and see how they actually do over the next few weeks. I think both of these strategies have a really good chance of making a lot of money in this scenario that the stock market falls and we see a bit of cracks in the system, which I think is a very low outcome over the next either year or 2 years or 3 years. Maybe not in January, but it's possible. January could trigger a sell-off. So that's kind of what I'm thinking. And these strategies, I think, would be both very interesting ones for that. We'll wait for them to finish getting built, and then we will back test them and we'll see what the results are there. And I'll share that with you guys probably sometime next week. All right. Okay. It's been a pleasure. Happy holidays. Merry Christmas. I hope you guys have a fantastic time with your families. And I hope you guys, get everything that you dreamed of as a Christmas gift. And I will see you guys next week, probably on a different day of the week, because Thursday is Christmas, right? So we're not going to do that exactly in a week from now, but we might do Tuesday next week. All right. See you guys. Have a good one. It's been a pleasure.